Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Skarica, founder of the Addicted to Profits newsletter online at addictedtoprofits.net. He writes for the Financial Intelligence Report. He's speaking to us from the beautiful Bahamas. Welcome back to the show, David.
Thanks for having me.
David, is there a technical setup for a big correction?
Yeah, I think there's two things kind of going on here. I think that we're in a correction in terms of the gold and silver market, which we'll talk about maybe after talking about the regular S&P American stock market. But yeah, if you go look at, there's a couple things with the stock market is, I think it's going to be more than just a correction, because if you go look at, and I've talked about this in the past, the parabolic blow-offs that have happened in the tech sector, and it's not just like the FANG stocks, the big, the Apple, Netflix, Google, Amazon stocks. It's like a lot of these kind of, smaller, growth stocks like Zooms and Etsy and stuff of this nature. Anything that kind of, even some of the online car companies or some of the auto dealers in the States that have a lot of online sales, anything that kind of benefited from people not being able to go out and do their kind of normal business due to COVID or normal day-to-day activities, money seems to have flown into them, and they have these super inflated valuations and stock charts. So when I see that, it looks kind of like 2000s on the charts. You got these big parabolic blow-offs, and maybe we'll see some rotation. Maybe some of the old economy stocks, as the economy slowly opens back up again over the next 3 to 6 months, maybe they'll kind of stabilize and rally and, hide some of the technical damage. But I really think that the NASDAQ is maybe set up for a potential 50 to 70% bear market, similar again to 2000, actually when it fell almost 80%, because of this parabolic nature. And if you ever look at these parabolic graphs, you go back to Nikkei in 89 or the Dow in 29 or gold in 1980 or NASDAQ again in 2000 or the home building stocks in the United States in 2005, 2006, when you have these parabolic moves, they usually end with these huge multi-year kind of bear markets and crashes. So I don't see why this time would be kind of any different. So I think that's what we're kind of in the early stages are. And another thing about this secondary move is that, and this is also sometimes what happens in these parabolic blow-offs, again, it's just driven by these few stocks. So actually a lot of stocks haven't really participated in that rally. And again, like you talk about anything tourism related or travel related or consumer spending related has been hit due to COVID. So these stocks didn't really participate. It was just driven by a few stocks. And that kind of thin market rally, not really bad tech internals, they call them, the Vance decline line lagging, usually is what happens near the end. And then we talked about this in the past too. You've got these Robinhood traders and these millennials and people getting their inflated unemployment checks, and a lot of them, because they were just sitting around doing nothing, it wasn't like they got these things and they could go on a vacation to Florida or Hawaii. They were sitting around their houses and trading stocks on their apps on their phones, and because the millennials tend to be drawn to these kind of high growth tech companies that they use, a lot of the money from that kind of went into that as well. So I definitely think, we're definitely starting this. And one thing that may happen is maybe after the election, no matter who wins, you kind of just get to sell the news scenario. Of course, if the election ended up being a disaster, like the 2000 election where it's close and disputed, that would probably even increase the size of the sell-off. And then you could see, again, this move continuing to the end of the year. feels a lot like, in a way, as a more extreme version of 2018. If you remember what happened in 2018, there was kind of a mini blow-off in the market early in the year, and then the market really got slammed in February. This time it really got slammed in March. Then there was a rally back to new highs in September, October, and then the market rolled over about 20% from those highs into the end of the year. So it kind of feels like that. And also, if you go look at kind of the date at the top of the market, which was like early September, that seasonally has been a time when markets at the top, like 87 happened in the top happened in late August, 29 happened in early September, 2000 happened in the secondary the first bear market rally, ended again in early September. So seasonally, that also tends to be a time where, the market's top. And if you're looking for like more stimulus, especially on the monetary front from the central bank, I don't think you're going to really see that until we get another leg lower in the stock market and they do a round of stimulus to fight that. So it's kind of a catch-22 that they're in, that, people want all this stimulus, but it probably won't happen until whatever the market drops 15 or 20% again. And remember, we're talking from very inflated levels. The S&P went back to 3,600, about 3,300 to 3,400. It's already dropped nearly 10%, but it's went up so much, it's so inflated. Like a bear market would put you at roughly, 2,800 on the S&P, which is still a really inflated level really hasn't never seen until the last year or so. So I think, again, it's more than just a correction or a technical correction. I think that due to the nature of this parabolic stocks, it's going to be something much more. And what I would do is watch how these stocks react to news. Like one stock that I'm short, you put options in my newsletter, CarMax, which is one of these car selling companies that benefited at first from kind of spike in online sales. They had their earnings like a week or two ago, and the stock got absolutely hammered on the earnings. So I think if you start seeing that, and the earnings actually weren't that bad, but just the stock is so overvalued. But if you see stocks like selling off on good news and that sort of thing, that's probably a sign that this is getting near the end. And then you got a stock like Nikolai, which it looks like it's almost like a scam now. That has been absolutely hammered. That kind of blew off with the whole hype around electric cars and Tesla and et cetera earlier in the year as well. So I think when you start seeing stocks like that, which are shady companies, and when they start to be exposed, if you remember in 2000, you had the WorldComs and the Enrons, and, in 2007, 2008, we had, the Lehman Brothers, and, even though it wasn't a stock, Bernie Madoff being exposed, a lot of the mortgage frauds were exposed. So I think when you start seeing these scam stocks blow up, that is also a sign that you are kind of near a top in the market.
We'll have more with David Skarica right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with David Skarica. David, what's happening with gold?
Again, we kind of saw this blow off in gold, and I think some maybe momentum money moved into it, and it started to become like almost everyone, I'm a long-time gold bull, so I'm someone who's in for much lower levels in both these gold equities and gold itself, but when we started seeing that big move into gold, and I remember when the initial kind of correction happened, everyone wanted to buy that dip, right? And that was just kind of like, this is probably going to be a little longer correction. If you look at seasonally too, again, that August, September period tends to be a short-term top seasonally for gold and precious metals, and then it goes down into about November or the U.S. Thanksgiving, and then can kind of consolidate there, even in bull market, and then moves higher into the end of the year and into the spring of the following year. That tends to be kind of the seasonality of gold. So we're kind of in the seasonal, lull. Like the short term, like I said, the monetary stimulus is kind of gone. But I think what happens is that at some point when the stock market, the equity markets fall enough, what ends up happening is, the market and gold kind of wakes up and says, hey, they're going to print a bunch of more money again, maybe do another stimulus package, especially after the election when we finally do have a winner. They'll probably announce some kind of stimulus package, or, Trump will call it infrastructure, or Biden will call it some form of a new Green Deal or something, next year. And then you'll see maybe the kind of, gold rally on the hopes that, inflationary pressures do that spending and the printing of money kind of bail out the market. I expect gold, kind of like it did, in the spring, that even if it does fall with the stock market in the initial correction and decline, I would expect gold to bottom before the market and then be stronger than the market coming out of those lows. Because similar to the spring, or even similar to 2000 to 2007 period when, the gold was breaking out to new highs in 2003 when the stock market was just beginning, like a 4 or 5 year, bull market. So that's kind of what I would expect here, that, that we kind of consolidate. I think 1800 should hold on the downside, kind of the old, resistance becoming support. And then we kind of break out late this year, early next year. And, I think the next breakout, because you're really going to see the acceptance of the deterioration of the national debt. Like, I don't really want to talk about the debate, but one thing I found interesting about the debate, and I knew this was going to happen, they did not mention the national debt or deficit or spending once in the whole debate. And, you're going to have probably a $5 to $6 trillion deficit in the States this year, almost 30% of GDP, which is higher than even any year during World War II. And the debt itself is 26 trillion, 130% of GDP, which is like Greece, Italy levels. So it's like you have this extreme move in the debt and no one's even talking about it. I think at some point, even for the world's reserve currency, that you're going to start getting pressure on that. You can't just keep running up this debt and deficits forever. And there's nothing really happening right now. You're just doing bailouts to keep people on life support. And if you want to use that analogy, when keeping someone on life support and the patient is going to die, you're not really, doing anything to, you're not investing anything. You're not going to save this person's life. They're not going to live well afterwards. They're going to die. And, that's kind of what the economy is going to do if you keep racking up all this debt. And so, we're just doing short-term bailouts, inflated unemployment, payments, in the States, the $1,200 stimulus. Canada's doing it too with the CERB. So it's like at some point, the market will have to react to that. And the one interesting note about the States, a lot of people think the States can just be like Japan, where the debt has been astronomical and rates are still zero. But there's two differences between the States and Japan. And this is why I think it's really bullish for gold too, is that the States have a lot more of their debt held by foreigners. Japan's debt is almost all domestically held, and Japan has a current account trade surplus, meaning that they could kind of support those fiscal deficits because they have a lot of money coming into the country because they sell more than they buy, and the U.S. doesn't have that. They have a fiscal and current account deficit. So I think at some point, and if they start to do things like universal basic income or, reparation payments or whatever, and these ideas that are being thrown around, I don't think foreign investors are going to buy U.S. bonds to pay for that. I don't think they don't mind, foreign investors might not mind paying, buying bonds if they're doing an infrastructure project to kind of rebuild kind of some of the falling apart infrastructure they have in the States. But I don't think foreign investors are going to go for, supporting the socialization of the largest economy in the world. So, I think those are all factors. And what I'm trying to say is that could at some point, all this debt, put upward pressure on interest rates. And the thing about upward pressure on interest rates is we don't need 1970s rates to basically really hinder the finances of the country because the debt is so high. If that 10-year bond goes to 3%, which is historically still a low level, it's going to be very detrimental to the government's finances. And remember, that will probably be globally, because if you go look at these bond markets around the world, and I'm talking about Canada, a lot of the European markets, they tend to track what the States is doing. So I would think that if the States bond market at some point does somewhat roll over and interest payments go higher, that is going to happen in other Western nations at all. It almost will be like a global revolt against all this government spending and stimulus. And remember, the argument in the 30s was that the government didn't go far enough to bail out the economy when the Depression started. I think now we've kind of gone too far to the other side, where the government is doing too much to kind of bail everybody out. And by the way, I would think that this kind of deterioration in the government's finances is reflective by political candidates and who's running and the promises that they're making. And because they're, again, when someone makes a promise now, no one even asks about, the fiscal consequences of it. They just like this idea of whatever, a universal basic income or the whatnot. But anyway, all this stuff, is, to get back to gold, is really positive for gold longer term, like the macro view, not just the next 2 months in a consolidation. It just means more printed money, more stimulus, and, if we do start seeing that uptick in interest rates I mentioned, don't worry, the central banks at first are really going to try to fight that. They're going to try to buy almost every bond out there to suppress rates. So it will be an interesting dichotomy to see what's going on when that's happening. But again, long term, like I was someone who thought longer term gold was going higher, and these debts and deficits were going to go higher because of, the baby boomers retiring and the strain on the government finances. Well, this has more than exceeded my expectations. I never thought we would see a 25 to 30% deficit as a percentage of GDP unless we were in another world war. And so this has been, absolutely off the charts.
We'll have more with David Skarica right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with David Skarica. David, what do you see happening with the U.S. dollar?
Again, in the short term, if we kind of get this, usually when the market declines, they have this dollar trade where it's a tightening in global liquidity, and the dollar tends to benefit from that. And if you go look at most of the 2000 to 2002 bear market, it wasn't until right at the end of 2002 that the dollar really started to roll over. And then same thing when 07, 08. In 2008, you had a big spike in the dollar, and you saw a spike in the dollar this March. So the dollar in the short term may definitely strengthen it. And it just might not only be that trade. It's like, if you look at the relative performance of economies, the problem with the measures taken in Canada and Europe due to COVID is this is a pandemic. I just don't think you can avoid, just have everyone locked down and avoid people from getting it. It's why they're called pandemics. So what will probably happening, because the U.S. has somewhat opened up, and in a way, they're kind of bungling of the pandemic may help them, because they might hit the kind of herd immunity before these other Western countries, maybe outside of Sweden. And then you might see this relative outperformance as well, and that also could maybe strengthen the dollar, a bit. I definitely think that combination, that and like I said, the tightening of global liquidity, if there is a decline in the market, short term will prop up the dollar. But I think, again, to get back to my earlier point, the response is going to be so vicious in terms of fiscal stimulus, monetary stimulus, printing of money, infrastructure projects. It's just that will really crumble the dollar. And again, to talk about relative, if you go look at the amount of money the U.S. is spending on a per capita or, percentage of GDP basis, it's much higher than the European countries or even Canada is spending. And that, again, kind of is going to blow up their deficit even larger. And they think they can do it because of their global reserve currency. But I think at that point, the dollar begins to roll over as well. And I think, too, politically, politics around the globe is not great right now. But I think what we're seeing is a bigger breakdown in the U.S. political and social fabric than other countries. And again, that also, again, because you have to look at it from a foreign investor's point of view, you might just say, hey, I don't want to invest as much in the U.S. Like, I'm talking about the Western world, but, countries like South Korea and Taiwan, they've had very, tepid recessions during all of this. So I think money may begin to flow into the Asian and emerging market economies. And I think because of their actually much lower debt level, especially at the government level, they're going to come out of this actually much stronger than countries in the West. So I think you might see, again, a period like the 2000s happen again when, if you go look at from 2001 to 2007 to, India, South Korea, Taiwan, Russia, et cetera, all really outperformed the developed world. So I think that would be another thing that can come out of it. That will take a while to shake out, but once it does, I think that move into emerging markets is definitely something you could see, and because they're just not going to have a lot of the social unrest problems that a lot of Western countries are going to have, or to that extreme.
David, are people who have taken all these unemployment benefits and so on, who have got into the world of trading, about to get a rude awakening?
Yeah, because I think you talk about, like I'm Gen X, right? I just turned 43 actually, and my first bear market was 2000, but I actually wrote a book in 1998 predicting that the tech bubble would burst, called Stock Market Panic, in a bear market, because I had a little more historical knowledge of the markets, maybe than the average 22, 23-year-old at the time. So, but like what I saw then was a lot of my generation. We were kind of like the first generation that really, got the internet when we were teenagers and became enthralled with it. And a lot of them were trading, the JDS Uniphases and Nortels and, people, AOL at the time, Yahoo. And a lot of them owned that because, again, they were young people and those were the services they used. But the thing about that is that took a number of years, like people were getting involved in the 90s as that mania developed. This is really a short-term thing, and you've got a lot of investors, trading small amounts of money on Robinhood apps or the whatnot, and it's like they haven't even gone through. And they luckily started because the pandemic lockdowns and unemployment benefits started in March, April. They started right at the bottom of the market. So they've never seen a real correction or bear market. At least in the late 90s, people had saw the 98 Russian crisis, the 97 Asian crisis, been through a little bit of volatility. Now, none of these people have experienced anything like this. So I think, definitely they're in for a rude awakening, especially because, they're in these 30, 40 stocks that have been momentum plays that have led the way higher, and they'll probably lead the way lower, and then it becomes like the old saying of an elephant going through a peephole, that once those stocks kind of roll over and you got a bunch of investors who've never seen a bear market go in that, they're all going to be running for the exits at the same time,
Dave, anything else we should be keeping an eye on?
No, that's really right now. Actually, another market I would watch is oil. We talked about gold, that if we kind of see this and maybe another slowdown, we're entering the flu season, maybe that will slow down the economy. Cases will rise again, and then COVID, this could be maybe the last spike. If you look at the history of these pandemics, they tend to only last 1 or 2 years. So maybe that will be kind of the end, but maybe that will also dry up demand for oil and gas again, and we see this kind of final leg lower, maybe some more bankruptcies or more write-downs, and oil stocks go down, and that might bring the final kind of great buying opportunity in oil and gas, and especially if you're someone like me who believes after we get through this decline phase, or deflationary phase, initially we enter in the period of stagflation. Oil and gas should be quite well, partly because I think supply issues. You'll see a lot of production coming off in, like, say, sectors in the States, oil sands in Canada, and even places like Saudi Arabia and Russia will be more reluctant to put supply back on the market once it turns higher because of this big shakeout we just had. And I think oil and gas in the fourth quarter to the first quarter of next year should have a very, very good buying opportunity.
David, thank you so much for chatting with us.
Well, thanks for having me.
My guest has been David Skarica, founder of the Addicted to Profits newsletter, online at addictedtoprofits.net. If you have any questions for David or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.